Hello everyone, it's time for us to get started with our lesson for today. Let's go ahead and begin. As usual, always take a few moments to refresh your memory and read the disclaimer. All right, today we are going to talk about three key areas or three key topics. First, we're going to begin taking a look again at the day's structure. And we are going to delve a little bit into the questions of market control. And then we are going to conclude our discussion with a review of TPO counts and how those also help us in determining and identifying imbalances in the market, which give us an idea about opportunities as they develop. All right, let's begin by taking a look at the day's structure. We've already begun to speak a little bit about the day's structure, and we've looked at a couple of different days. And I'm going to review those with you once again. We've looked at several different types of days. We've started by looking at a standard trend day, and we've looked at the double distribution trend day, and we've also looked at a non-trend day. We will just take another glimpse at them today, and then we're going to cover three new different types of daily structures: what is known as a normal day, a normal variation of a normal day, and a neutral day. So this will give us the complete picture of the 6 different types of daily structures that are likely to develop during any one day. And the reason that we want to be familiar with those and be able to identify them is because at some point early in the day after the initial balance, we need to try to project and anticipate what type of a day the day is likely to be. And in being able to do so, this will help us tremendously to always be on the right side of the market and capture opportunities as they develop. All right, let's review again quickly what a standard trend day looks like. And it is characterized by a number of different characteristics. First of all, the open test drive. Standard trend day is very directional in nature, be it an up direction or a down direction. We're going to see either an open drive or an open test drive. And here, in this case, we have a test drive. We dropped a little bit, and then the market continued in a set direction. You're also going to see a wide initial range. That's always very characteristic of a standard trend day or a directional day. And as you can see here, we do in fact have a rather wide initial range. If you take a look here in the initial balance, we do have a wide range. The range is beginning to expand very early in the day. So you see period B begins to create a range extension for us. The other characteristic of a standard trend day that is very important to observe: higher highs and higher lows. And immediately we begin by seeing that from period A to period B to period C. Period A has a low here, period B, here's the low, so obviously that is a higher low. And similarly, here's the high for period A and the high for period B. Notice how much higher it is. Those are all very indicative of a strong directional day. And we continue to see that the same happens. For period C, here's the low for C, here's the low for B. Obviously, C has a higher low than B, and it also has a higher high than period B. So we're continuing to see higher highs and higher lows. Also, this will be accompanied by an increase in volume. Typically, when traders notice that we are in a directional market, everyone wants to come in on the action and benefit from it because it presents some very profitable trading opportunities, and therefore you begin to see an influx of volume into the market, and you will observe that by looking at the volume as it builds up for the day. The next type of trend day, if you will, that is not a standard trend day is what we call a double distribution. And here we have two double distributions. And let's begin to take a look at the characteristics of a double distribution day. You will find that they don't look identical. They can vary a little bit. Sometimes we'll have a single print between the two distributions. Sometimes there won't be much of a single print. It'll just be a small print like this, or a double print. In any event, what really happens is the market begins with a very small initial balance. And as you can see here, we have a small initial balance, and here again we have a small initial balance. They're almost both about equal in size. Then a change in events occurs. So the market has been active in the morning, and we developed this distribution, and then all of a sudden in G period things change. What happens is prices start to drop significantly. And if you notice, G period extended the range down, so we get a change in events. Basically, the other time frame seller or buyer steps into the market and decides that they're going to move value in a different direction. It could be higher or lower. On the first double distribution day that we see, they decided to move it lower. On this day, the opposite happened. The other time frame trader came in and actually moved value higher up here. So when the change in events occurs, we begin to see a range extension in the direction of where value is going to move. And then we begin to see a new distribution develop. That's why it's a double distribution. During the early part of the day, we have a distribution that develops, and then a change in events occurs. Value moves directionally during the day, and a new distribution develops. And this is why we call it a double distribution, because we actually get two distributions, or two values, value distributions in one trading day. And nevertheless, it's still directional in nature, because the new distribution will either be higher or lower than the prior distribution. And we've talked before about both the standard day and the double distribution days as both being directional types of days. We also talked a little bit about what we call a non-trend day. Now notice that it opens up also with an open test drive. So it really is meant to deceive you a little bit, to give you the illusion that we're going to be in a directional day. So just because you see an open test drive, don't get carried away and think immediately, aha, I'm going to have a directional day. It could very well be a completely non-trend day. We have to then look at other pieces of the puzzle to really determine what type of day this is likely going to be. And of course, one key question that we have to look at is where this open is relative to the prior day's open. If in fact I am opening within value, in the value area of the prior day, that increases the likelihood that in fact I am going to see a non-trend day. So we have to begin putting together the different pieces of the puzzle that we've been learning to create a mental image in our mind of the day's structure, how the day is likely to unfold, and what kind of a pattern is likely to develop for the day. This really does not happen overnight. This is a skill that takes a little bit of time for anyone to develop. You really have to just know what you're looking for, first of all, and that's the purpose of our lessons. And then two, you have to practice it. You have to take a look at a lot of days. So initially, begin with paper trading, looking at the different days, and trying to identify how is this day likely to develop. Already, I have given you an exercise that I hope you've been doing, gathering the data about the open range, the close range, and so on. Now, as you accumulate these data, now begin to attach to each of the days that you've done in the past the type of day that the day was. How did that day develop? Go back now. Hopefully you have in your binder all these sheets and all the profiles, so you can go back. And this is the purpose of the binder. We build on what we know. It is very important for any trader really to continue to build their database of knowledge and information. So when you gather this data, now is the time to attach meaning to it. So now you want to, for each day, take a look at the data and then identify the type of day that developed. You will begin to see certain patterns emerge. The ranges of the open for directional days you will find are quite similar. The ranges for non-trend days are going to be somewhat similar. So now you have the added advantage of actually the research and the data that you've collected that gives you a clearer picture on what is likely to happen. The market continues to repeat these patterns again and again. The more we study them, the more we learn about them, the better we become as traders. So the non-trend day may begin with an open test drive, but it fizzles out as soon as you see there's no range extension, and the second period B drops back down and covers most of the prior period A. So it gives us an idea that this is going to be a narrow initial range. We didn't get much of an expansion. Already telltale signs of a non-trend day. We also get a wide TPO at the POC. Wide TPO meaning we get a lot of prints at the fair value. And we have about, actually almost 13 here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So almost the entire day we were hitting this same price over and over again. That is a very strong characteristic of a rotational market and a non-trend day where really no one was in complete control at any part of the day. They were participating, but really no one took control of the day. No type of directional movement. All right, now it's time to introduce to you, these are the three that we've already talked about, to introduce to you a different type of daily structure. And this one they call the normal day. I certainly did not pick the name for it, and I will begin by telling you that the term normal day is really somewhat misleading because it may imply to you, or it may make you think that this is normally what happens each day, but really nothing could be further from the truth. We don't see normal days occurring very frequently. Actually, they occur very seldom in the market. However, normal days are often triggered by news announcements early in the day. So let's see what happens when we get a news announcement early in the day that gives us a normal day. The typical characteristics of this normal day is a wide initial balance. So to some extent, it begins to look like a directional day. Normal days, again, actually are not all that normal and don't occur all that frequently. And normal days are always triggered by news announcements or changes that happen suddenly in the market. So we will get a wide initial balance. Why are we going in a loop here? Okay, let's begin with the normal day print and take a look at how that develops. We get a wide initial balance, so take a look at the A period here and look at how much wider it is than most typical days. So when you get a wide initial balance like this, you should begin to suspect I may have a normal day on my hands. And then all of a sudden the B period opens up and it's still trading within the range of that wide initial balance. And we continue to see that the day goes back and forth and distributes within that same initial balance. So the characteristic of that normal day is this wide initial balance. And by wide, you will see it'll be significantly wider than any of the other days that we have discussed. By keeping track and actually recording the day's open range, this makes it much easier for you to be able to identify, because you actually will have values that will give you an idea about what wide is, what a narrow range is. And incidentally, I should also mention to you that this varies significantly from one instrument to the other. And that's why it behooves us to record this data and to look at it in the market. So once we get this wide initial balance, we find that a high or a low will have been put in for the day, and then the market begins to rotate within this wide initial balance. We don't continue on. If we did, it would be an actual directional day. It would not be a normal day. So in a normal day, we get a wide initial balance that is simply followed by a rotational market. Those are the characteristics of a normal day. Now, let's take a look at what we call a normal variation of a normal day. And really, the biggest variation is the initial balance is not as wide as it is on a normal day. So that's the first thing that you're going to find or observe. And what happens, though, the range extension occurs later in the day. So we do have a little bit of a range extension in the day, but it occurs a little bit later, not in the initial balance, and a new area of value or balance is established after we get this extension. So here's what happens. We'll look at the normal variation in stages. So instead of the very wide initial range, we will get a regular range, if you will, or a somewhat limited open at the range. And then the next period will tend to stay within. And so it begins to look like we're going to get a non-trend day. But take a look at what happens all of a sudden. Let's look at how the day begins to develop with stage 2. First of all, we get the stage 1, no clear trend. We open with a small initial balance, and we stay within that initial balance. Take a look now what happens in the second stage of this. All of a sudden, during the day, D period, we get a range extension. So the other time frame participant decides to step in. They didn't do it very early when we first opened. Perhaps the news event or the triggering factor was a little bit later in the day. And when that occurs, all of a sudden, it pushes prices down, and we get strong selling, and then we get a range extension. So this becomes the second stage of our normal variation of the normal day. And then what happens in the third stage is we begin to distribute in a lower range. So if you notice here now, the market starts to distribute in this area up and down, up and down. Once again, we don't continue on because it's not a directional day. This is, in fact, just a normal variation of a normal day. So if it were, in fact, just a normal day, it would begin with a wide initial balance. The variation is the range extension in the balance comes a little bit later in the day, and that's what makes it a variation of a normal day. All right, let's move on to another type of structure, what we call the neutral day. And the neutral day is kind of interesting. In a neutral day, the other time frame buyer and seller are not far apart in their view of value. So both the other time frame buyer and the seller have a close perception of value. They both feel this is really where the market value is. So the market then, what it does is it starts to auction back and forth between this shared perception of value. So in a neutral day, what we see happening is the other time frame buyers and sellers are both actively present in the market. Of course, one of them is selling and one of them is buying, but they're both present in a neutral day. So here's what we begin to see happen. The characteristics of the neutral day is the initial balance or the base of the day is rather wide. It's somewhere between the width of a trend day and a normal day. And once again, these are qualitative descriptions. When you actually look at the data that you gather for the instrument that you trade, you will develop a far clearer picture and a more accurate number that you'll look at that'll give you an idea about the extent of the the base or the extent of the initial balance for a neutral day, simply based on data collection and observation. The base is a little bit narrow. It's not as wide as a normal day or as a trend day. So because it's narrow, it can easily be upset during the day. Always think of this. When you have a wide base for something, it has more stability. It has a better footing, if you will. If the base is narrow and small, its footing is not really very sturdy, and it's easy to tip it over one way, towards one side or the other. If you have a lamp at home and your lamp has a small base, you'll find that your lamp has a propensity to drop or to fall down frequently. But if it has a wide, large base, it's stable. It sits in its place with more secure. And the same holds true for our initial balance. When we get these narrow, small initial balances, they are likely to get upset sometime during the day. And we're going to see the day's extremes develop outside, unless, of course, outside that initial balance, unless, of course, we end up with a completely non-trend day. However, in most cases, you will see some sort of a range extension. In the case of a neutral day, the range extensions actually happens on both sides of the initial balance. So there's no directional bias to it. We will see an extension to the upside and an extension to the downside. That's why we call it a neutral day, because the extensions that we see are not directional in nature, they're neutral. And I'll show you what we mean by that. Take a look at a recent day of trading that we just had here, and it was in fact a neutral day. Take a look at, we'll begin with really our initial balance. And notice, we open, and then we get some prints above, and we also have some prints below it. And this is sort of a rather wide initial balance, but it really is not the widest that you would anticipate, but it could conceivably be, when we see this, a directional day. But notice now what happens when B period opens. Well, B period opens right around the middle of A period. And it begins to rotate around this middle once again without any kind of range expansion. And let's take a look as the day progresses. All of a sudden, C period begins to drop, and we get a range extension to the downside. And then D period comes along, and then all of a sudden, prices move back up again. And then E, F, G continue with periods L and I. As we get later in the day, we start to move up in the other direction. So take a look. We've had range extensions for the day on both sides of the initial balance. One time we went below it, and the other time we went above it. So this is the characteristic of a neutral day. We extended or expanded our range on both sides of the initial balance. As you can see, we went up above the initial balance, and we also went down. So no directional bias. We were really neutral. The interesting thing that I also want to point out to you is look at the actual extent of the extension beyond initial balance. It's almost about equal. Neither one was really larger than the other. This also helps you in making projections. If in fact you begin to see that you are in a neutral day and you are fortunate enough to pick up on that at the right time as prices come back up and they're heading in this direction, you can then begin to project where are we likely to end up on the high end and add this amount of value to the top of the day, and you are likely to have a nice trade by the end of the day come to fruition for you as prices continue to escalate and balance the neutral day to the upside. I want to take a moment here to actually show you how the day develops in this little video so you can see what a neutral day actually looks like, because these days, when you spot them, they can have some great trading opportunities. And the interesting thing about them is they usually fly in the face of sort of common sentiment. It looks like you're picking up a falling knife when prices drop precipitously like this, but all of a sudden then they move back around and you see the market completely make a U-turn all the way into the other opposite direction. So they're very tricky, and if you misdiagnose it and the market actually is dropping, it can be dangerous. But if you get it accurately, you basically are able to pick up a trade fairly early on and carry it to fruition all the way to the high on the other end of the day. So let's take a look together at what this day actually looks like as it develops. Now notice, drops, then comes back up again. You will see sort of it builds that range by expanding back and forth around the open. There is no clear directional conviction. Watch the open as it progresses. See that? Came back down again. Went back up. Now, take a look at the initial balance. The initial balance B period is on looking here like it's going to stay at the top, and value is moving towards the upside. So it really is somewhat misleading, because now you will see as prices drop when D period comes. See that? The range got extended to the downside, and now it looks like we're moving lower and lower. But then suddenly, look at that. All of a sudden, it gets picked up and it gets carried all the way up. And we will talk a little bit more today about what causes that and why this happens, and then prices continue to move higher and higher. Okay, and that's our close for the day. All right, let's move on here. Now, to make things a little bit more complicated, a neutral day also has two types. So it's not just one type of a neutral day. You can actually, in fact, observe and find that two types of neutral days can occur in the market. The first of which we call the neutral center, and I'll show you why in a moment, and the other one is what we call the neutral extreme. So the neutral day itself has two different types, the neutral center and the neutral extreme. The neutral center day occurs or happens when the trading day closes with the price in the middle of the day's range. So even though we get an extension to the top and an extension to the bottom, ultimately at the end of the day, what is happening is value is coming back to the center. What does that tell us? Well, it tells us that we have a balanced market, that there is no directional conviction of the in this neutral day. Really, we had a neutral day and we ended up with a neutral day. No directional conviction whatsoever. However, a neutral extreme day tells a very different story and gives us a different picture. And what we will find immediately is the trading day will close with price either at the high or the low extreme of the day. So the neutral extreme day actually gives us some sort of a directional conviction. We are not neutral anymore at the end of the day. We're either moving higher or we're moving lower. So if the close is at the high, this is telling us that the other time frame buyer has demonstrated greater directional conviction. They're now in control and prices are likely to move higher. If the close is at the low, the opposite would hold true, meaning the seller is in control and we are likely to see movement in the following day in the opposite direction, or in the direction of the conviction to the downside. So let's take a look at the day that we were just looking at, the neutral day, and let's take a look at where it closed. And it closed right here at the high. So obviously this was a neutral extreme day. It did not close at the center or in the middle of the day down here. It closed way up here. So we did have a directional bias to the day. After all, it wasn't completely neutral, and the bias is to the upside. You will also see that there's another telltale sign that we have learned to look for and to look at, and we'll spend a little bit more time talking about this. Let's take a look at the volume. And if you notice, below the volume POC, I had 1.19 million, whereas I only had 37,123. That's quite an imbalance, and the imbalance favors the buyers. So obviously the buyers were in control throughout this neutral day, and the bias is to the upside. Now let's take a look at the TPOs for the price, and they in fact confirm for me, or verify and validate, the very same fact. 23 above and 147 below. This was definitely a market that was controlled by the other time frame buyer, and we have a directional bias at the end of the day towards the high side. So that's why it's good to be able to identify whether you have a neutral extreme day or a neutral day that closes simply at the middle and stays neutral. Let's review together now the different types of day structures that we have discussed together from a directional conviction perspective. First of all, the least directional conviction we're going to find is in what we call a non-trend day. And then comes the normal day, and then the neutral center day. Then we get a normal variation day, then the double distribution. But ultimately, the biggest directional conviction we're ever going to see is in a trend day. These are our actual trending days. So all the others show lower levels of conviction, and the conviction increases depending on the type of day that we see, but ultimately your biggest conviction is going to occur on a trend day. All right, let's go back to discussing the issue of control and trying to identify and answer some key questions about control. Remember, our two key control questions are: who is in control, and when does the control weaken or end? All right, so how do we find out who is in control? First of all, we know that we can have single time frame control, where one of the two, either the other time frame trader or the short-term trader, is in control, or we can have both of them exercising control in the market, both the short time and the other time frame trader both exercising control. Let's begin by taking a look at the single time or the one time frame market. And basically this is when one participant is in control. A one time frame market is the characteristic of a trend day, because there's only one side, one party that is in control. it is able to move the market in the direction that it wants to. So if it's the buyer, the other time frame buyer that's in control, prices will move up. Obviously, if it's the seller, the other time frame seller that's in control, prices will move down. This is the one time frame market, directional, one side has control. It's also important to note that when we get a non-trend day, we also have really one participant that's in control, and that's the local or the short-term trader. That means that both the other time frame buyer and the other time frame seller are out of the market. So when we see non-trend days, who's in control? It's the short-term trader, or what we call the local or the market maker, the short-term trader basically. So now you understand, hopefully, the characteristics of a single time frame market, and we want to take a look at a two time frame market. The characteristic of a two time frame market, first of all, is that the other time frame trader is present and the day time frame participant is sharing control with them, and that's why we call it a two time. There's two different times at play together in the market. It's not just about one single time frame that's dominating and controlling the market. So what we end up seeing during those days is price rotates up and down without any clear directional conviction during the day, until we get a period where all of a sudden a single time frame market participant begins to take control. The other time frame control is identified for us, or we can always detect it when we see the following types of evidence. On the extremes of the profile, we've already talked about the tails. So when you see tails appearing on the profile, it tells you that the other time frame is in control at that particular moment of time. And it indicates strong other time frame activity. Range extensions, when we begin to see our ranges during the day being extended, are also another characteristic that tells us that one time frame is in control and is pushing the market in a particular direction, and as a result of that, we're getting range extensions. These range extensions are very important for you to keep an eye on, because they also help us to gauge the strength of control. How much of a range extension are we seeing, and how much of a penetration back is occurring also comes into play. We also see the other time frame control in the body of the profile. And let me explain what I mean by this again. I don't want you to ever think that the other time frame market participants only participate on the peripherals of the market, or only when we get to extremes. They are active in the market at different times during the day for different reasons and at different levels. So very often they are also quite active in the body of the profile in the value area. Now, they could in fact come in and push value one way or the other, or they could just have a minimal amount of involvement that really does not tip the balance in favor of one direction or the other. But don't ever assume or think that the other time frame trader is not involved in the value area or in the body and building the body of the profile. The key question then that we want to begin to focus on is, well, if they're going to be involved in the body, in the value area, how are we going to see and how can we tell this involvement? We've already talked about the fact that the short-term trader is really the dominant player, or the one that loves to trade in this value area. So how can we tell when the other time frame trader is also in there with them? And this brings us to the TPO counts. They give us some very valuable information. And that's why we have to continually monitor them. You need to be always looking at the TPO counts. And I'm using the acronym now, working with the assumption that everyone already knows and is comfortable with what a TPO is. It's the time price opportunity, the unit that makes up the entire profile. And so when we look at the count of these TPOs that are occurring during the trading day, it gives us an idea and it helps us evaluate the presence and the control of the other time frame trader within the developing value area. How does it do this? Well, it helps us see the level of imbalance between the other time frame trader and the day time frame trader. Only when this imbalance exists. So if I see a balance, if my TPO count above and below fair price or the point of control is pretty much equal, then there really is no imbalance. So don't always assume that there is an imbalance. But now what we want to learn to quickly identify, and it's usually fairly easy to identify, is when this imbalance actually occurs in the market. So the imbalance occurs when there are other time frame buyers more than there are sellers, or when there are more other time frame sellers than there are buyers. What does this really do to the market? Well, the locals end up with this imbalance. And let's explain a little bit what we mean by all this. Let's backpedal a little bit and talk about the role of the market maker or the local and why it really disturbs them when they fall in an imbalanced situation. The market maker or the local has the job of facilitating trade. They're really the go-between. They're the middlemen in the market. So whenever anyone wants to sell or buy, they're usually going through the broker, and then the broker goes through the market maker or the local. Rarely do we ever see transactions that are conducted directly between the other time frame buyer and the other time frame seller. Transactions are always flowing through the market makers and the locals. That is really their role, and that's how they make their money. And sometimes in the middle of the day, when the imbalance occurs, the local's inventory becomes what is known as overloaded. Let's talk about these types of situations. First, let's talk about the ideal situation for a local or a market maker during the day and how they make their money. As a local or a market maker, when an order comes in from a broker has a client, of course, and the client's interested in selling, let's say, 10 contracts at 12.82. The local then decides to buy these 10 contracts at 12.82. And then within seconds, another order comes in to buy the contracts at 12.82.25. So the local sells these same 10 contracts for 12.82.25. What have they just done? They've made a small profit. And they do this time and time again, many times over during the day. That's how they make their money. They're always making these small profits on a large number of orders. But what's important now is I want you to focus on their inventory. Since they always have to buy, they have to be present in the market. They can't refuse buyers or sellers. And that's why they facilitate the trade. That is their role. Their position is balanced in this case because the local or the market maker sold the very same contracts that he had just bought. So his inventory, theoretically, at this point is zero, if that's all he has. But normally they have a much larger inventory. They're working with quite large sums of money and large inventories. So this is the ideal scenario for them. This is when they are balanced, and this is why they love to work in the value area, because it's easy for them to make money in the value area, lots of trade going back and forth, and this is the area where fair price is. Now, what happens all of a sudden when we begin to see an imbalance in the market? or the local's inventory is overloaded. Here's how this happens. All of a sudden, the other time frame seller puts on the market an unusually large number of sell orders. They hit the market. Now the market maker has to buy all those. So naturally, all of a sudden when they buy them, his inventory grows. He has lots of contracts. And in the lingo of the industry, this is known as he's too long. Too long meaning he has too many long positions. So what's a market maker to do? He has purchased too much from the other time frame trader, and now his inventory is overloaded. Well, we know that his goal, the local, needs to bring this inventory back into balance because an imbalance has happened. Now, many traders will tell you, well, the obvious thing to do is let him sell. He should just sell this excess inventory. But think about it. He's been buying this now, and if he starts selling it, prices will continue to drop even further, and he's going to lose more and more money. His goal is to always to try to make money. And on this long inventory that he's accumulated from all of this selling, the only way that he can make any money on it is if prices start to move back up. So he really doesn't want to sell or start dumping on the market, because if he does that, he shoots himself in the foot and prices continue to drop lower and lower, and he's buying more and more at lower and lower prices, and he sort of digs a hole deeper and deeper for themselves. So that is the exact opposite of a market maker's action. Here's what a market maker does when they get overloaded or too long. His priority is to stop the selling that's flowing into the market. So he drops his bid price significantly. And usually the drop is not random or haphazard. They have access to something that you and I don't, which is the order book. So they look in the order book and they see, where is the other time frame buyer? Where are they sitting, waiting, willing to buy? He wants the help of this other time frame buyer to come in and use their force to push prices back up. So all of a sudden, you will see the bid price drop dramatically down to a certain price and then jump right back up. Well, what's happened is, sure enough, the bid price dropped low enough to attract the other time frame buyer. And what's happened is, as a result of that, is the tail that you see. The tail occurs and takes place because all of a sudden the other time frame trader was brought into the market. And this is what we call responsive behavior. He wanted the other time frame trader to respond. He nudged them. He said, guys, I know you're sitting down there. You think this is a great price down here. So here it comes. Here's the price for you. Grab it. And sure enough, the other time frame traders jump on it and they grab the price, and the price starts to move back up very, very quickly. And now the market maker is quite happy because prices now are starting to move in the direction that he wants. He doesn't want them to keep dropping. And sure enough, if the psychology of the market continues, the rest of the players in the market will begin to jump in on the action, and they will start buying as well, and that continues to push prices higher and higher. Now, it doesn't always happen as nicely as this. Sometimes the seller decides, well, I really have more inventory to get rid of. Thanks for bringing the price back up to me. Here you go. Here's some more inventory. And then we actually, in fact, begin to see prices continue to drop. So this is where the profile structure and looking at the balance and imbalance really helps us to get a good handle on what's happening in the market and what type of a day is developing. So when you get those neutral days and you see a range extension to the downside, this often happens as a result of a bid price dropping low enough to pull in a responsive behavior from the other time frame buyer to bring them into the market. It's a rather interesting dynamic to watch, and here's how the TPO count really helps us to see this in action. When we look at the TPO count, unfortunately, this, for us, the software makes it even easier and easier because it does all this calculation for us, but I want you to understand it and understand what it means. First of all, when you see those two numbers at the POC, realize that they exclude all single print tails and all the TPOs at the fair price or the POC. So we don't ever include the single print tails or the prices at the actual POC. We're only looking at the prices double prints or more or greater above and below the POC. So we look at above the point of control, and basically the TPO above the point of control represents or tells us the other time frame traders' willingness to sell and stay short above value. How willing are they to sell and stay short above value? So as this number increases, the other time frame trader is committed to the selling. There is more selling than there is buying, if in fact the number above the point of control is larger than the number below the point of control. The number below the point of control is really the other time frame traders that are willing to buy and stay long below value. So we have two competing forces, and this TPO count tells us which of these competing forces is starting to dominate and where's the imbalance. So just so that you get an idea about how the calculation develops, I broke out for you, if you take a look, this is where the POC is right here. And if you begin to look, now remember, the single print is out, we don't look at that, and all the TPOs right at the POC we don't include in the calculation. So if you begin with the line right above it, we have 5 TPOs, then 3, 2, 2, 3, 2, 2, 2, 2. And this is the column, the 2 columns right up here. That's how they break out. And similarly, if you look at all the columns down here and all the TPOs, this is how they break out below. Take a look at the imbalance in this case. 23 above to 147 below. Who really is in control right now? The buyer. The buyer is in control. 147 to 223, that's a very wide ratio. And so you are likely to see prices continue to move in an upward direction. The buyer is in control and pushing prices higher. Now, certainly this can and does change during market activity. Our job is to monitor it. What the profile tells us is what is happening in the present, and by understanding what's happening in the present, we are able to project what is likely to happen in the near future. However, as we continue to look and monitor, we get fresh signals and we need to adjust and react accordingly. All right, so basically what this is telling us with 23 above and 147 below is, folks, we have one heck of an imbalance. Now, what happens when markets are at an imbalance? They want to move to balance. So we need to be moving in some direction or the other. The buyer is now in control, so we need to watch and see when will the sellers step in to try to bring this market back into balance. Now, having discussed the various roles and the ideas of control, we want to spend just a little bit of time revisiting the concept of responsive versus initiative activity. Responsive activity is when the other time frame buyer or seller responds to the imbalance. Okay, so in the chart, or the profile that we just looked at a couple of moments earlier, we have an imbalance. What we're waiting to see is when will, and we know that the other time frame buyer is in control. When is the other time seller going to respond to this imbalance? Now, the profile tells us that they're going to respond. We just need to now be able to identify when the response begins. And when it begins, we want to be a part of it. Now, initiative activity, on the other hand, occurs when the other time frame buyer or seller creates the imbalance. So they are the ones that are initiating the imbalance rather than responding to it. See, we knew from this chart here that we have a state of imbalance and the buyer is in control. The buyer can never be in control forever. At some point, the sellers have to respond. And this is what we need to understand and realize as profile traders. Already, we are able to sort of know the dynamics of the market, what's likely to happen. We know there's an imbalance, and we're waiting for the response. When will this response occur? We will see. And that's what you need to be looking for. So hopefully now you can see the difference between responsive and initiative activity. Now let's take a look at it in terms of TPOs. Initiative buying and responsive selling TPOs occur above the prior day's value area. This is important to note and understand. And responsive buying and initiative selling TPOs occur below the prior day's value area. So now I need to be looking at the TPO counts and TPO activity also in relationship to the prior day's value area. So any TPO activity within the prior day's value area is considered initiative, even though it is not as strong as the initiative activity that takes place outside of the value area. So obviously, as we mentioned earlier, the other time frame traders do participate and do have a role in the value area. And that's why we still perceive their activity as initiative in that area. However, to be able to distinguish whether the activity is initiative or responsive when we're outside the value area, we need to take a look at the prior day's value area to make that determination, whether the activity is responsive or initiative. And let's take a look at an example together. So let's begin by identifying the prior day's value area, and hopefully everyone is able to see that. And let's take a look at our initiative buying TPOs. Remember, all the TPOs that are occurring within the prior day's value area are considered initiative. Okay. Now, and here we have our responsive buying tail. Why is this responsive and not initiative? Because the other time frame trader responded to the prices when they dropped. They didn't initiate it. The market makers dropped the bid down to bring them in, and sure enough, they responded to the occasion. Now, why is this initiative buying TPO and not selling TPO? If you notice, prices are moving higher, and the imbalance that we've looked at the TPO count tells us that the buyers are in control, and that's why this is initiative buying and not initiative selling. Last but not least, our initiative buying range extension. Now notice, because we are above the value area, the behavior now is initiative. It's no longer responsive. It was responsive down here when they stepped in to bring prices up. They responded to the opportunity. But here we had initiative buying in the value area, and it continued on with initiative buying to the upside and extended the range. So now we're in initiative buying, and notice how initiative buying occurs above the prior day's value area. So now I want you to be able to detect and identify initiative buying and responsive selling and so on, and be able to look at it relative to the prior day's range. And with that, we will conclude our lesson for the day.